Imagine waking up to learn that your country's currency has lost half its value overnight, that your savings are suddenly worth scraps of paper, and that the crisis unfolding on your doorstep is so severe it threatens financial markets thousands of miles away. Now imagine that this collapse wasn't entirely unpredictable, that the warning signs had been blinking red for years, yet some of the most powerful financial minds on the planet insisted everything was fine until it wasn't. The year was 1994, and what happened to Mexico's peso wasn't just a local disaster. It was the spark that revealed hidden weaknesses across the global financial system. This is the story of a crisis that many people assume was small and contained, yet in reality reshaped the way nations borrow, banks lend, and governments defend their currencies. And the mystery you'll want to solve by the end of this video is simple. How could a single country's currency collapse spiral so far out of control that the entire world had to scramble to contain it? To understand how the disaster formed, you have to picture Mexico in the late 1980s, a nation standing at a crossroads. After a decade of runaway inflation, debt defaults, and stagnant growth, Mexico's leaders believed they had found the cure. Their plan was bold and in many ways seductive. Stabilize the currency, liberalize the economy, open the financial system to the world, and attract foreign capital to fuel a new era of prosperity. At the center of this vision were President Carlos Salinas de Gortari and a team of technocrats who saw themselves as architects of a modernized Mexico. They believed that if they could anchor the peso to the US dollar and keep inflation low, confidence would return and investment would pour in. And for a while, they were right. Money flowed, interest rates fell, and the world applauded Mexico as a rising economic miracle. The country joined NAFTA. Foreign companies lined up to invest, and international banks praised Mexico as proof that emerging markets could transform themselves almost overnight. But what no one wanted to acknowledge, even though the evidence was growing louder, was that Mexico's miracle was built on fragile foundations. The government kept the peso stable by selling dollars from its reserves. The problem was that those reserves were shrinking faster than they could be replenished. Investors didn't notice because they weren't looking. They were chasing returns, and Mexico's returns were irresistible. In the early 1990s, as global interest rates fell, investors went searching for higher yields. Mexico offered them exactly that. The government issued short-term bonds called tesobonos, cleverly designed to look safe because they were payable in dollars. This reassured foreign investors who feared a peso devaluation, but this reassurance came at a price. If the peso ever fell, Mexico wouldn't just owe money, it would owe dollars, a liability that could multiply instantly. As billions of dollars rushed in, Mexico began to resemble a house whose lights shine brightly because the owners are quietly draining the generator. Behind the scenes, its current account deficit widened dramatically, meaning the country was consuming far more from abroad than it was producing or exporting. That deficit had to be financed with foreign capital. And foreign capital, as history repeatedly shows, is loyal only until the first sign of trouble. Meanwhile, the peso became increasingly overvalued, making Mexican exports less competitive and imports cheaper. The very stability that was supposed to be Mexico's strength was slowly turning into a trap. Then came 1994, the year everything unraveled. It began with the Zapatista uprising in Chiapas on January 1st, the day NAFTA took effect. Investors shrugged it off at first, but confidence had taken its first hit. Next came political assassinations. First, the ruling party's presidential candidate, Luis Donaldo Colosio, in March. Then a high-ranking official, José Francisco Ruiz Massieu, later in the year. The markets pretended not to panic, but underneath the surface, capital was becoming skittish. Every shock reminded investors that Mexico's stability was more illusion than reality. The Salinas administration tried to project calm. They insisted that the peso was under control, that reforms were working, that foreign reserves were adequate. But this was only partly true. Reserves had fallen from around $30 billion to less than $10 billion, and then to dangerously low levels. The government desperately needed to maintain confidence, because confidence, not fundamentals, was what kept money from fleeing. By the time Ernesto Zedillo took office in December 1994, the situation was already combustible. Zedillo's team inherited a bomb with a lit fuse. They faced an impossible dilemma: keep defending the peso and drain the last of the reserves, or devalue it and risk triggering the panic they feared most. They chose the latter, announcing a modest devaluation of around 15%, but they had underestimated how dangerously reliant Mexico had become on investor psychology. Investors saw the devaluation as confirmation that Mexico's finances were worse than anyone admitted. They didn't wait for more news, they ran. In a matter of days, billions of dollars fled Mexico. The peso collapsed far beyond the intended 15%, plunging nearly 50%. Tesobono obligations, suddenly much more expensive in dollar terms, ballooned into an unpayable burden. Mexican banks faced insolvency. Inflation surged, and interest rates soared. Workers watched their purchasing power evaporate. Foreign investors who had once praised Mexico's openness now abandoned it with breathtaking speed. But the crisis didn't stop at Mexico's borders. The shockwaves hit global financial markets, surprising investors who believed emerging markets were safer than they actually were. The U.S. feared that Mexico's collapse would disrupt trade, trigger mass migration, and destabilize North America's new economic relationship under NAFTA. Wall Street banks feared losses on their Mexican holdings. And Washington worried that if Mexico defaulted, it would shatter confidence in emerging markets everywhere. In response, the United States led a massive $50 billion rescue package, controversial, urgent, and unprecedented. Critics called it a bailout for Wall Street. Supporters argued it was necessary to prevent a global contagion. The International Monetary Fund, too, played a major role, providing emergency loans but requiring harsh austerity measures that would deepen Mexico's economic pain. The goal wasn't to save Mexico from suffering, it was to reassure creditors and restore stability to the financial system. Yet even with these drastic efforts, the fallout spread. Investors began scrutinizing other emerging markets. Suddenly, countries like Argentina, Brazil, and Thailand looked risky in ways they hadn't before. The term tequila effect entered the financial vocabulary, describing how one country's crisis could intoxicate and destabilize others. This chain reaction planted early seeds of the Asian financial crisis just 3 years later, reinforcing a pattern that would echo into the 2000s, 2008, and even modern crises today. When liquidity dries up in one corner of the world, the shock tends to race across markets faster than policymakers can react. Mexico clawed its way back eventually, but the cost was immense. Recession, unemployment, bankruptcies, and years of lost growth. Meanwhile, the global financial community quietly rewrote the rulebook. Countries began stockpiling foreign reserves. Central banks adopted stricter currency management. The IMF reshaped its lending frameworks. And investors became more aware, though not always more cautious, about the dangers hidden in emerging markets. But if you think the story ends in the 1990s, look closer. The patterns that caused Mexico's crisis didn't vanish. They resurfaced in startlingly familiar forms. Rapid foreign capital inflows, overvalued currencies, rising short-term debt denominated in foreign currency, fragile investor confidence that can reverse in an instant. These elements appeared in the Asian crisis of 1997, in Russia in 1998, in Argentina in 2001, and most dramatically, during the global financial crisis of 2008, when complex financial products, not tesobonos, became the ticking bomb. Even in the 2020s, emerging markets continue to face versions of the same trap. Debt that seems manageable until it isn't. Flows of capital that feel stable until the world changes direction. Inflation that appears under control until it suddenly breaks free. One of the most shocking modern parallels is how quickly currency reserves can vanish even today. In 2022, for example, a major emerging economy saw more than 20% of its reserves evaporate in a matter of months due to capital flight and attempts to defend its currency. Another example, more than a dozen emerging markets currently carry significant portions of their sovereign debt in dollars, just like Mexico did in 1994. History doesn't repeat perfectly, but the rhymes echo loudly. And perhaps the most sobering connection is the illusion of stability. In 1994, Mexico looked like a model student of economic reform right up until the moment the foundation cracked. In 2008, the United States seemed to be enjoying a golden era of financial sophistication until the housing market collapsed. Today, several advanced economies and emerging markets project stability yet beneath the surface. Their vulnerabilities look eerily familiar. Debt loads at historic highs, speculative capital chasing quick returns, and central banks trying to balance inflation, stability, and political pressure all at once. This is why the story of Mexico's peso crisis still matters. It wasn't just a local failure, it was a warning. A lesson that global financial systems are interconnected, confidence is fragile, and even minor shocks can escalate into global emergencies. The mystery at the start wasn't just how Mexico's collapse affected the world, it was why the world didn't see it coming. And perhaps the real question is whether we'll recognize the signals next time before the crisis hits. If there are 3 takeaways from this story, they're these. First, financial stability isn't about growth or reforms alone, it's about resilience, about how well a nation can survive when confidence evaporates and investors flee. Second, global finance works like a network of dominoes. When one falls, others wobble, and no country is too far away to feel the impact. And third, crises rarely explode out of nowhere. Their roots are planted quietly, years in advance, in decisions that seem reasonable at the time but compound into disaster. So as you think about modern markets, rising global debt, and economies that appear stronger than they might actually be, consider this question. If a shock like the one in 1994 happened today, with markets more interconnected and capital moving faster than ever, would we be any better prepared? If you found this deep dive into the past both eye-opening and eerily relevant, make sure to like the video, subscribe for more long-form investigations, and hit the bell so you don't miss the next chapter in understanding how financial history shapes our world today.